But otherwise, it is necessary in today's world that we take a certain amount of risk. Uh, so, Tanya, welcome. Good evening. You're here with us. So, I hope that Paresh ji and Praveen ji also managed to come in. Let me just check and see whether they have sent any message.
Good evening, sir.
Good evening, Tanya. There is no message from Paresh ji or Praveen ji. So I just hope they can come in time.
You're mute, Tanya.
Tanya is busy with a college project, Shruti. So now she doesn't have time for us.
No, sir.
She's all busy with a project, and okay, it doesn't matter. That's all. So you have to handle this also, handle that also. But uh, basically, the point which, so what I'm going to do today, Tanya, is that I will start again. Because my general feeling was that, I have not been able to make you people understand, properly what exactly it means to invest in equity, how you should invest in equity. So without any further delay, I will start, and or maybe we can wait for 2 more minutes if somebody else comes, and then we'll see what to do. See, in our course now, what we have is we will finish this equity part. Today is the last lecture. After this, what we will do is we will look at other channels of investment. So other channels, there is real estate, and there is gold. Those are the two things which I was actually looking at. So we will look at that, the other alternate channels of investment. I had allotted 6 hours for that, but we have spent, I think, more time on this equity section. Like, for example, today, this 2 hours that we are spending on equity, this in fact is 2 hours extra. 6 hours were allotted for this. So probably what we'll do is we will take these 2 hours out of the next section, which in any case is not very, what should I say? It is more of a theoretical thing. It is not something which most of us will actually do. So that part is done. And apart from that, then of course we will move into the accounts part. So we'll be looking at different financial ratios. We'll look at working capital all over again. And then we'll end it up with a little bit on banking. So those are the parts which are left. It's 6:05 now. I think we will now make a start. And here we are. Just a minute. Let me just stop the share for a moment and just go back. See, let us just quickly see what we did, so that today we will cover this whole thing and complete this thing in a good way, so that at the end of it, you understand exactly what has happened. So we began by defining equity, and this was not a problem. All of you understand that basically equity is all about share capital, buying shares in a company. Only two things to remember out here. Equity, there is no guarantee that you will get your capital back. First thing to remember. Second thing is, you cannot sell it back to the company. You have to sell it in the share market, in the secondary market. These are the two things. Then we looked at this example of starting a company, where we said that Ramesh and Mahesh want to start a company. And then I showed you how exactly, if the company is doing well, they are able to give themselves bonus shares. Then they are able to get the company valued. And after getting the company valued, it is possible for them to go for a issue of shares. This was just a background so that you understand that this is how exactly shares are issued. Then we looked at this concept of P ratio, because one of the traditional methods which is still used, maybe it is not so effective, but it is still used for understanding whether we should buy a share or we should not buy a share. That is the PE ratio. The PE ratio is what? Price to earnings. That means price per share divided by earnings per share. What exactly is the ratio between price per share and earning per share? Price per share is, see, if you go to the share market, the current market price of the share, you think of that as the price per share. As far as the earnings per share, that is basically the total net profit of the company divided by the number of shares that the company has issued, and that will give you the profit per share, also known as the earnings per share. So we said that an old technique was that if we want to understand what is the value of a company, we can do this by looking at the PE ratio. That is basically, we look at the earnings per share, and then we say that this is the earning per share for this year. During the life of the company, the value is going to be at least 10 times this or 15 times this. So we make our own assessment. And if the market accepts our assessment, then it begins to buy the share at that price. So in this example here, we said that we will take let's say the share the book value of the share is rupees 10. And we say that the earnings per share is growing at 15% every year. Then we say that, let's say that the price per share is going to be 15 times the actual earning per share. That means the P ratio is 15. And then I gave you this example to show you, when we say that the EPS is growing at 15% per year, what does it mean? So I showed you this, that if I buy it at 150 rupees, over a 10-year period, the profit alone is going to come to 203 rupees. That means the dividend which I will get during this period will be about 203. At least that is the amount of earning per share which the company is going to have. Whether they give it as dividend or not, that is a decision which the company will take. But this is the total amount which is going to be earned by your share. And then we said that during this 10 years, there will be a capital appreciation. That means the share price will go up. And as the share price goes up, you will be able to sell that share at a higher price. So this was just to understand PE ratio. And then we said that while PE ratio may be okay in the case of industries where, which are stable industries, which grow year after year. So every year the earnings grows. It is not suitable for cyclical industries. So where we said that it is possible that there is normalcy, and after some time, there is a boom, and then the share prices go right up. And then after that, you come to a stage when that level is not sustained anymore, and the share price crashes. There is a bust. So these things happen with the economy. They are reflected in the shares, and these industries are typically referred to as cyclical. So we said that steel, petrochemicals, tires, sugar, these are cyclical industries. So you cannot use a PE ratio concept for such industries. This was one of the points that we had made. And then we said that we can classify stocks as blue chip stocks of well-established companies which are considered safe. Now, today, during the second part of the lecture, we will actually question this assumption. We may say that though it is considered safe, is it really safe? But the traditional wisdom is that blue chip stocks are generally considered safe. So this was one thing. Then we said that income stocks are, of course, are for people who are more interested in dividends. And these companies generally give more dividends and more consistently. Every year they give dividends than other companies. So those are known as the income stocks. Then we thought of growth stocks, where these stocks can be, if you stay with this stock, then the chances are that over a period of time, you'll make a lot of money. That was one thing that we said. Then, of course, there were cyclical stocks. And then finally, we mentioned, welcome, Praveenji. And so good evening, Praveenji. Nice to see you here today. I hope you have been able to look at some of these lectures which I've been giving and this class participation on YouTube in the videos that are there. I hope that is helping you. If at all you have a problem, if there is anything at all, I would very strongly recommend that you send me anything on WhatsApp that is not clear to you. I'll do my best to clarify that. That of course goes for all of you there. So we mentioned these different types of stocks. And then we came to this concept. So since there are so many different types of stocks, what should our strategy actually be? And here we said that there can be two approaches. One, of course, is fundamental analysis, and the other is technical analysis. Now, in fundamental analysis also, we can sort of divide this into two parts. One part relates to quantitative and one part is qualitative. So we'll talk about these two and we'll talk about qualitative. And then at the end of it, we'll end with how you should actually invest. So that is what I plan to do today. Are all of you with me so far?
Yes, sir.
That was a very quick revision of what we've done so far. Okay, Tanya, Shruti, Praveenji, I hope you're all, you understand exactly what has been covered here. Praveenji, I was just saying that we are just quickly going through the whole of equity today, and we will end the equity section today. The reason we are doing it repeatedly is that my feeling is that maybe some of the fundamentals here are not being grasped properly. So that's it. Then, in fundamental analysis, quantitative, we said that there are three main statements that we need to access. We need to get these statements from it's publicly available. It's made available by the company in the interests of investors, students, researchers, everyone. So we can get these. If you just go to Google, you just type profit and loss statement or balance sheet or cash flow statement, put the name of the company, it will direct you to a site which will give you all these details. It's not a problem at all. In fact, yesterday we had done a small exercise on this, and if I'm not mistaken, we had done this last week also, so that all of you were clear about this aspect. So we looked at these three statements specifically. And then we said that there are various ratios that we should look at, which will give us an idea about the performance of the company. So we said that one thing that we can look at is earning per share. We can look at the P ratio. We can look at the dividend payout ratio. How much dividend does this company give generally? We can look at the profit itself. And there are many other things that we can look at. The return on equity. We can see the actual cash that is available with the company. Now, coming to this last point, this concept of free cash flow. Today, basically, I want to start at this point, this free cash flow point, because if the company is making profits, but still does not have sufficient cash, then it can be in deep trouble. And that is why it is not enough to just be happy if I find that the company has made a good net profit. So what we will do is we will look at this thing again. So first of all, what I want you to focus on is this: understanding the difference between profit and cash available to the business. So you understand me? There is profit and there is cash available to the business. Normally, we think that if a company has made profit, it must be having a thick bank balance. So it's probably done very well, and there is no reason for me to worry. But if we look at some specifics in the accounts, especially which is available in the cash flow statement, we begin to understand that this may not be the case. Maybe the company has made profit, but despite the fact that it has made profit, it has not actually generated cash. So to understand that, let us just try to understand some basics. So when we say net profit or net income, it's the same thing. We say that operating profit is equal to income minus expenditure. Shruti, Tanya, you're clear on this?
Yes, sir.
Tanya? Yes. So where will we find this? This we will find in the profit and loss statement of the company. So operating profit is income minus expenditure. This is very simple. Next, if from operating profit, I reduce interest and I reduce depreciation, then I will end up with profit before tax. After that, whatever I get, I pay the tax and then I'm left with profit after tax. But the tax part is something which is not in control of the company. The tax is something which the government decides the rate. What the company can best do is basically try to focus on this, how it can increase this. Now, so we know what net income is. We understand what profit before tax is. Mainly focus on this, income minus expenditure. Now, income or revenue, you can use any of the two words. This is generally where do we get the income from? From sales. So whether we are selling services or whether we are selling goods, physical goods, we generate income from the sales of these goods. Please note, income is not profit. Income is simply the amount, the selling price, the amount which you sell a good for. When you sell it, you get a certain amount of money from each customer. That is your income. From the income, when you take away the costs, you will then arrive at the profit, the expenditure. So keep reminding yourself about this point. Now, if we look at this sales that we have made, one part of sales is cash sales. That means whatever was paid, whatever was sold, the company received payment in cash. Payment in cash doesn't mean actual physical cash. Maybe somebody transferred the amount into the account of the company. It could have come in any way. It could be a simple Google Pay transaction. It may be a RTGS or an EFT transaction. But one way or the other, whatever was sold, the value of that was received by the company directly in its bank account. So that is a cash sale. Now, if all sales were cash sales, there would not be any problem with this. Then we would simply say that there is no difference between the actual cash available and the profit figure. But look at this. The other part is credit sales. See, a large part of the sales which are made by companies are basically on credit, because people who buy from you, they have one advantage. They will say that, look, we are willing to buy a lot of in bulk from your company, but for that we require you to give us a certain number of days to pay. If you want the payment today, then sorry, sir, we can't buy from your company. We'll try to find another company which can give us some time to pay. And the time to pay which you give is called the credit. Now, when you sell on credit, You have made a sale. See, so your sale figure has gone up. You have not received any money. Please note, you have not received any money for the credit sale. But from an accounting perspective, your sale figure has gone up. So how do you account for this? You call that unreceived amount the receivable. This has not been received as yet. So in the balance sheet, on the asset side, since this is something you are going to get, this is called a receivable or accounts receivable or trade receivables. Different words are there. Basically, they capture the same thing, that goods have been sold on credit and cash has not been received by the company. So this is one important thing. Now, the second part is expenditure. Now, expenditure, once again, can be of two types. The first type will be where you have purchased services or goods in cash. For example, if you are dealing, if let's say it's a manufacturing company and you have raw materials, you have to buy raw materials, you have bought these raw materials in cash. You have paid your employees in cash. So that is one part. Cash has gone out of the business. But then there are those things which you have purchased on credit. So for example, you may, your suppliers of raw material may say that, look, you are very reliable, you buy from us very regularly, therefore, we will allow you a certain number of days to give us the payment. So in which case, you have received something from the supplier, whatever it is, a raw material, a computer part, anything, and you have not paid for it. So once again, a cash has not entered the picture. But because you have to pay for it in the future, we refer to this as a payable. It is going to be paid in the future. And from an accounting perspective, what we do is we put this in the balance sheet on the liability side because you have to pay, and that it will appear there as either accounts payable or trade payables. One of these words will be there to tell you that you have to pay. It can also come under the word creditors. So that is one. Now you understand that this income and this expenditure is then not so simple, because in the income there is a component of credit sales where cash has not entered the picture. And similarly, in the expenditure side, there is a component of credit purchases where cash has again not entered the picture. So that means if I have a simple income minus expenditure equation, whatever I get, that profit or net income may not be reflected in the cash that I have or the cash with the company, because there are certain non-cash transactions which are taking place here and here. Apart from this, there is a different perspective, that is depreciation. So we'll come to that. But before that, let's just say that there is a company which makes all credit sales. It doesn't have cash sales at all. It makes all sales on credit. What will happen? This business will have profit, but it will have no cash. And I can tell you that as a banker, that this is one of the reasons why accounts become NPAs, why people who take money from the bank and who actually sell a lot of the goods that they have, that they stock, but they do not have the cash to repay the bank installments because they have sold on credit. So if you look at their cash flow, you will find that it is negative, even though they have made a profit. So this is something to remember, because this becomes important when you are trying to identify a company which you consider good and in which you may invest tomorrow. That is one point. So to find out the actual, and the other point I was trying to make is that there is one more entry which is not related to sales or purchases, which is a book entry, but it is a non-cash entry, and that is depreciation. So depreciation, if you look at the profit and loss statement, in the expenses side, somewhere you will find this particular line item, depreciation and amortization. And these two things basically are expenses which are book entries, which are done basically to create a fund for the replacement of assets at a later stage. You can think of it like that. Every asset has a certain life. So what I do is, as 1 year passes, I depreciate the asset. I write off a bit of the value of the asset, because it has less value than it had a year ago. And in the process, I reduce my profit, because this expenditure column also has depreciation. So if I want to find out the actual amount of cash in the business, I have to adjust the net income for all the non-cash items. And what are these non-cash items? All sales made on credit, all purchases made on credit, and depreciation. Is everyone clear about this?
Yes, sir.
Or is it? Tanya?
Yes, sir.
See, you say yes, sir, but later on when I ask you something, then you become confused. You must understand this properly, because on the basis of this, we can understand what free cash flow means. Are you sure you understand, or is there any point here which you're not understanding?
No, sir, understanding, sir.
Okay, fine. Then let's go to the next point, operating cash flow. Now here, I'll just show you this. So what I'm doing is, I am trying to find out what is the cash from operations. So cash flows are divided into three parts basically. There is, Shruti, can you remember which three?
Investing, financing, and operating.
Investing, financing, operating. So this is the operating part. From our operations, from the day-to-day work that we do, selling and buying stuff, what exactly how much cash have we generated? Now take this company, it has a net income of 100. It has a depreciation of 150. It has receivables have increased during the year by 50. And payables have decreased during the year by 50. And now I'm trying to understand how I reach this figure of 150. So, and then there is this other company which also began with 100. It also had a depreciation of 150. In this particular case, the receivables decreased and the payables increased. See, here you can see that the receivables increased, payables decreased. Here it is reverse. The receivables decreased and the payables increased. And at the end of it all, we end up with this same figures up to here, but the operating cash in the company is very different. Here it is 150, here it is 350. Now, if I go to the, can you see this Excel sheet, or do I have to show it again? Is this visible?
No, sir.
Okay. Then I think I'll have to share it specifically, because it is linked, but apparently, so now it will be visible. Now you can see.
Yes, sir. Now it's visible.
Now, so look at this part here. Net income is 100. You can see this. Net income is 100. So to derive net income, what are we doing? We are taking the figure here. We are taking the income. We are reducing the expenditure. Fine. Now we have depreciation, 150. Now depreciation is an expenditure. Shruti, can you explain this depreciation column here? Why it is added back to income?
Sir, in cash flow, we actually only reduce those expenses which are actually flowing out of the cash. अगर असली में flow हुआ है तो ही हम उसको reduce करते हैं. So in case of net income, we have already reduced depreciation. So we are adding that.
Tanya, can you understand that? See,
No,
when we say, so let me just explain this. When we see for this 100, to get this 100, what did we do? We said income minus expenditure. Now, when we said income minus expenditure, in the income side, whatever was the figure, let us imagine that the income side was, let's say, 250. And the expenditure side, or we'll have to take a bigger figure. Let's say the income was, let's say the income was 350. The expenditure was 250. Okay? So the income is 100.
yes,
350 minus 250 is 100. But in that 250 of expenditure, 150 is because of depreciation. And like we said, depreciation is something which is a book entry. That means we are doing this in the books, and we are treating it as an expenditure, but money is not going out of the company. Basically, in a cash flow statement, we just need to understand, has the money come into the company? Has the money gone out of the company? Now, in this particular case, in depreciation, even though it has reduced the profit because it is an expenditure, money has not actually gone out of the company. Can you understand this part? Tanya?
yes, sir, understanding. That means that वो 250 में से वो जो 100 निकला, the 150.
See, let me write it here. So let's say that my income was 350 and 250 was my expenditure. Okay? Let's say this is the case. Now, when I do this, I will end up here. I will get this net income of 100. Okay, Tanya?
Yes, sir.
Now, in this 250, 150 is depreciation. Now, suppose depreciation was not there. Then how much cash profit would the company have made?
So 250.
It would have made 250. So all that you are doing is you are taking that depreciation and you are adding it back to the income. Because this 150, which is already here in this 250 part, this 150 is basically just a book entry. You are just making an entry in the book. It has nothing to do with actual sales or expenditure or anything like that. It is just an entry that you have made in the book only for the purpose of depreciating the asset. You have used the asset, so you are reducing its value. Every year, any asset will lose value. If you have a car at home or a two-wheeler at home, as you drive that two-wheeler, the value goes down. The same way, if you are using an asset to produce something, every year that asset will become older, its value will come down. And in accounting, you do this through this depreciation. So you add this back. Now, the other thing which we notice here is that the receivables have increased. That means the sales figure 350, which you see there, it includes the credit sales for which no cash has been received. You understand?
Yes, sir. Yes,
Sales includes the credit sales for which no cash has been received. So since cash has not been received, we will reduce this again. We will also reduce this. So we will take 100, we will add 150, we will reduce this 50. And the payables, if you look at the payables are including purchases for which cash has not been paid. So cash has not been paid, but you have bought something. So this means that more cash has gone out than is being reflected. So you reduce this also. So the actual cash which is left with the company is this 150. And in this example, we do the same thing in reverse. So you work this one out on your own. Shruti, I think, has understood this properly.
Yes, sir.
Tanya, this is already here. This part you can sit down and work it out. Exactly what has happened. Okay. So basically, what happens here is that if we want to understand if a company is actually making profit, then making a cash profit, it is necessary for us to do this analysis. And then at the end of it, we are able to understand what the actual operating cash flow is. So if the operating cash flow is 150, this is the positive figure. From that, we look at investing. We'll come to that. So I've also made a few notes here. Whatever we spoke about a little while earlier, I have written that here again, which will clarify the point which we discussed with the Excel sheet. Now, if you look at the free cash flow means cash which is free to be used as you see fit. There are there is nothing else that you have to do with this cash. This cash belongs to the company. So we know that 150 was generated in cash from my operations. This was actual cash generation. Now, let's say, use some of that for the purpose of buying a machine or any sort of capital expenditure. Buying, let's say, increasing the number of rooms in my factory building, buying new machines, upgrading an existing machine, some form of capital expenditure we have done. That cash capital expenditure that we have done, that money has gone out of the business. So all that we need to do is we take the operating cash flow, we reduce the capital expenditure, and whatever is left, that is considered to be free cash flow. Is this clear?
Yes, sir.
Now, a good business, I want to find out businesses for the purpose of investing. I want to find out companies in which I will feel comfortable investing. So I will look at companies which have a good free cash flow, and this free cash flow should be increasing on a year-to-year basis. Every year it should be increasing. Then only I can say that it is something good. Then, point to remember is, a good free cash flow means that more cash is being received by the business, less cash is flowing out. In other words, more cash sales are being made, or credit periods are very short, less cash purchases are being made, or credit periods are very long. Why? What is this thing with credit period? It basically means that if I am selling to someone, and if I give him credit, I give him credit for a very few days. So maybe you don't pay cash tomorrow or today, but you will have to pay it in the next 10 days. So the company will get cash as soon as the person pays. If I don't give him a long credit period, I'll get the cash faster. Similarly, if I'm buying something, purchasing raw material, for example, if the supplier has a lot of faith in me, he can say that, okay, instead of paying it in 10 days, you take 20 days. So I have a long amount of time to pay. At the same time, I don't give that benefit to my buyers. Who can afford to do this? Only companies which are genuinely good, which have a good market reputation, and which is valued by the supplier. The buyer is also interested in buying from the company. The seller is also interested in selling to this company. So this is the point which this part, let's say, is a very, very crucial part in fundamental analysis. This is the point I was making. Then, of course, there was this exercise which we tried to do yesterday. Do you want me to go into this again, this part? Look at the exercise again, or should I continue?
No, sir, you can continue.
Okay, Tanya, I hope you will try to do this part, on your own.
Yes, sir.
Shruti had done some of this and had sent me complete answer for one company, you should also try to do the same and send me something. At least take one company and try to analyze it along the lines that we discussed yesterday on that basis. If you do that, then it'll be sort of easy. Yesterday, there was something which I shared with them, Shruti, which I'll just show you over here, which this I'll just show this to you. Okay, let me just. Okay, so this is something which I had done yesterday, Shruti, which I think you can try to do this with any company which you like. You will get a very good idea about how good or bad the company is actually doing. What you should do is, like from money control, you take these 5 years, March 17 to March 21, leave 1 year, one column in between each of the years. And then what you do is you work out the growth rate for each year. March 17, you can't get the growth rate because we don't have the March 16 figure. But for March 18, it is the amount by which this is more than this in percentage terms. So 14 over 11, you will get 1.24, that is 24%. Then you will see that it goes down to 10, goes further down to 8, like that. So what we are seeing is that the trade payables are going down. Okay, what does this mean? If trade payables are going down, what does this tell you?
The company is not getting materials on credit.
Yes, the company, or let's say the company is getting less materials on credit. So this is not such a positive thing. Now, if you look at trade receivables, the trade receivables part you should see is again something which is going down. So it was 2128. It increased here, not a good sign, because that means that the company is making more credit sales. It decreased a little here, decreased nicely over here. And then I think if you take March 19 as the base, then you can still say that it is being reduced, which is an okay thing. That's a positive thing because it means that what does it mean, Shruti?
That the company is selling more on credit.
No, more on cash.
Yes, sir. Yes, sir. Cash.
More on cash. So, so this particular thing will, this is important. You can also see one more thing. Look at the profit loss before tax. It is actually going, they are not able to show a profit. It has mostly been in loss. 2,353 crores, 946 crores, 2,398. 1 year in between in March 19, they had some profit. Then they have a heavy loss of 7,000 crores. Then they have 2,312 crores. And look, the interesting thing is that this is a big company, very well-known company, very well-established company. This is why I was saying that even in the case of well-established companies, it is very difficult to say that just because it is a big company, just because it's an old company, it will also guarantee you good results. So when I begin to look at the financials a little closely, I begin to see these things. That is one of the points which I am making out here. If you look at the revenue from operations, even here you will notice something very interesting. See, it was 48 in 17, went up to 58 in 18, 68 in 19. 19 was a good year for Tata. Then it has gone down. Maybe COVID has come in. It has come down and it shows a marginal increase to 46 out here. But this basically means that the income is stagnating at this level. The income is not going up. This is despite the fact that Tata Motors has been making a lot of sales of electric vehicles, which is good for the company. But despite that, you see that this is like this. So, when you begin to look at these things, the reality comes before you. You can see what the reality is. And that is the point I was trying to make out there. So, these exercises will help. This exercise and the next one, this is the Excel sheet which I just showed you. So, this will also give you a good idea. Calculate the growth rates, look at the trend, then you look at receivables, look at payables. You will begin to form a very good idea about how good or bad the company actually is. Now, let's look at some of the qualitative aspects in fundamental analysis. We have looked at the figures. So, for today, enough of figures. Onward, from now till the end of this lecture, we'll be looking more at non-figure things. Things which are less about numbers, more about what actually has happened. So, if I am trying to understand a company properly, I have looked at its financials, I should also look at the quality of its management. So, how much experience do the managers have in this line? For example, if I look at the website of the company, it will be very easy for me to look at all the people who are the division heads, the C-suite it's called. So let's say the chief marketing officer, the chief technological officer, the chief finance officer. So all these people are heads of their own divisions. How good are these people? So if you go to LinkedIn, look at their backgrounds, you'll begin to see what sort of a background they have. If they have worked in other companies, you'll find that out there. So you can see exactly what is the quality of these people who are managing these thousands of crores of rupees and in which company you are thinking of investing. Have a look at that. The second thing is, please look at the industry in which this company is operating. If the company is operating in an industry which is, let's say, it has already, suppose it's operating a thermal power plant. Now, in today's day, when coal is now not considered to be such a healthy option, somebody who has a coal-based thermal power plant is obviously a company which in the days to come, 5 years, 6 years ahead, may not actually be the best place for me to invest. But if I am looking at a company which is doing electric vehicles, I'm just giving you an example. It's what is known as a sunrise industry, an industry which is going to do very well in the days to come. Then investing there makes a lot of sense, because this means that even if, so remember we spoke about growth industries. So a company which is in a sector which is likely to do well in the future, we can think of this as a sunrise place, a place which is really going to do well, and this is a good investment for me. Then, what are the forecasts or projections of performance made by the company's management itself? If you look at the press releases which the company has come out with, if you look at what they are saying, how well are they going to do? See, if the management themselves are saying, look, this year is not going to be so good, we will try to be stable, try to maintain growth, then that means they themselves don't have the confidence. First of all, see what they have done. Then look at the previous quarter's results or the previous quarter, 2 quarters, just to see whether the performance of the company is actually moving in line with those projections. Whatever they had predicted, we'll do this in the full year. In the last 6 months, are they moving in that direction, or they're actually not doing it like that? So you understand what I'm saying, Shruti?
Yes, sir.
Tanya, are you getting the point?
Yes, sir.
So while we were looking at figures in the quantitative part of fundamental analysis, we will look at these qualitative aspects here. Then what is the market share that the company has? See, if the company has a very small market share and is struggling to maintain that market share also, then in the long run, you don't know how well this company is going to do. May not do so well, in fact. And then is this market share increasing or decreasing? And then there is another very, very strong thing here. Has the company invested in technology? You know, what we are seeing today is that those companies tend to do better who have actually invested in technology about 10, 20 years back, and who have continued to understand the value which technology can bring to them. So we took this example of Dr. Lal Path Labs. And when you look at Dr. Lal Path Labs, the reason why it is a leader in that segment is the fact that it has made such huge investments in technology. So because of that, they're doing well. You look at Asian Paints, they have done so well because they have invested so much in one of the best ERP systems in the world. So, you know, these are things which make these companies good companies. They make them stand out from the other companies. And because of that, they consistently give you good performance. So this is the qualitative side, which I was referring to. Book value, you can read on your own. This was a slide which I had made for an earlier presentation, but which is not that relevant. The basic thing in this slide is the book value actually may not actually give you a very good idea about whether this company is worth investing in or not. So let's just not focus any more attention on this slide for the moment. Let's just go ahead. So then now the next type of analysis that we have is technical analysis. Tanya, what do you remember about technical analysis from yesterday?
So
anything which you remember from this part. See, this technical analysis, this is not based on the fundamentals of the company. It is based on only two things. We only look at in the share market, what is the price of the share of the company over a long period of time, and we look at it not just over a long period of time, but within short periods of time, we look at it under a magnifying glass. So for example, we sometimes in technical analysis, you can even look at 15-minute variations in the share price within a day. Every 15 minutes, what happened to the share price? Did it go up? Did it go down? And when we do it like this, we are able to see certain patterns. We are able to see certain patterns in the way the price moves. And based on the, yes.
Sir, can you repeat what is volume of trading?
Volume of trading, how many shares were bought, how many shares were sold.
Okay.
So for example, let's say that the price of the share is ranging between 200 and 210. So if I look at one day, I find that it opened at 200. It went maximum up to 210, then went to 28, 29. So through the entire day, it was moving between 208, 200 and 210. But during the course of the day, how many shares were actually sold? How many? So the same amount of shares will be bought also. So what was this volume? Was there a lot of action? Were many shareholders interested in buying or selling shares of this company? Because that tells you whether people are interested or not. Otherwise, you may find if you don't look at volume, if you only look at price, then you will not get an idea about whether the share is something which people are interested in. Price will always be there. See, whatever was the last closing price on any given day, that is the opening price for the next day. And if nothing happens during the day, if no shares are bought, no shares are sold, then it will close at that price again. But what that tells you is that interest in the company right now, as on this day, is less. And when you want to invest, you want to take a call on the basis of technical analysis, it is only possible if a large number of people are interested in trading in that share. Otherwise, what pattern will emerge? It will be flat. You understand? Shruti, are you getting my point?
Yes, sir.
So that is the basic thing here. We have to look at different patterns. We'll come to the pattern part. So some stock prices will keep going up week after week, month after month. Patterns will never be permanent. A stock which is moving up after reaching a certain a point which is sometimes known as a resistance point, it will begin to go down. When it begins to go down, it may reach a point which is known as a support line. Beyond that, it's not going. It's again beginning to stay stable on the support line, then again move up again. Now, these things can appear to be random. They may appear to be random. But at the same time, these things quite often, they tend to happen again and again. And the same patterns are quite often repeated. So we'll look at some of the patterns in a little while. So what does the technical analyst do? He tries to predict, the pattern. And when he tries to predict it, if he predicts it correctly, he is able to make a lot of money. And the thing in technical analysis is that if you make money, you will make it during the day. It's very possible that you will make a lot of money in one day itself. Because if their share is volatile, if a lot of trading is happening, this is why the volume of trading is important. If a lot of trading is happening in that particular share, it is possible that the share prices will be very volatile. It will move up, it will move down. So if you can predict accurately the movement up and down, you will make money in minutes. And this is not something which I'm just saying off the bat. This is a fact. The people who do this properly, who are in a position to do it, who have a very good understanding of this form of analysis, they are actually able to earn a lot of money. But remember, it is very risky, and it is even more risky if you are doing it without an understanding of these patterns. That's one. So because it is, the share prices are basically unpredictable, that's why this whole technical analysis thing is sometimes referred to as a random walk. That means random means it can go in any direction. It can go up, it can go down. But what the technical analyst says is that even though it can go up, it can go down, over a long period of time, it is possible to understand which way it is going to go. And this is the basis for taking decisions to buy or sell. So this is one point here. The other thing in technical analysis is, so a fundamental guy will say that, but you're not looking at the financials of the company. So whether the company has a good ROC, whether it has good sales growth, whether it has free cash flow or not, you're not actually looking at that at all. The technical analyst will say, I don't need to look at all that. Basically, everything about the company is being captured in the price. So the market is composed of millions of investors. These millions of people are deciding consciously to either buy the stock or to sell the stock. So the wisdom of all these people will take the share price in a particular direction. And if the company has some stuff in it, if it's actually good, this entire body of investors will recognize that, and that will reflect in the share price. This is the point which the technical analyst says. So he says there's no point for me in breaking my head over ratios and in looking at the trend of sales or the trend of profit or receivables and payables and free cash flow. We don't need to do all that at all. We just look at the price, we try to understand patterns, we look at historical patterns, and on that basis, we try to actually take a decision. So this is one thing here. Now, when we say this, we also should try to understand what sort of patterns there are. So before we get to the actual types of patterns and how they are used, we'll take a short break. Okay, Shruti, Tanya, short break. I'll be back in about 5-6 minutes. Is that okay?
Yes, sir.
Yes.
Yes, sir.
Okay. I think we'll start. All of you are here. Shruti, Tanya.
Yes, sir.
Fine. So we'll continue with that. Okay. Now, when anybody who has heard a little about technical analysis, one of the things which they are bound to remember.
Excuse me, sir.
Yes.
So one doubt, sir. That time you were telling about that कि अगर कोई भी shares नहीं खरीदता है, sir. After that, what you told, sir, there was some network issue. वो
Yes.
मतलब हाँ, इसी में सर आप बता रहे थे एक पॉइंट, जो शेयर्स कोई अगर नहीं खरीदता है तो फिर इसका टेक्निकल एनालिसिस कैसे होता है?
I'm not sure which part of the discussion you're talking about, but
I think she wants to know that अगर कोई शेयर नहीं खरीदता है तो उसके ग्राफ में कोई भी चेंजेस नहीं आती, इट विल बी फ्लैट. हाँ, तो वही होता है कि कुछ चेंज नहीं आता उसका वो ग्राफ में, अप डाउन कुछ भी नहीं, बस वो फ्लैट है.
नहीं. Let's. Acha, I get it. I think you're talking about the volume part.
Yes, sir, volume part, right, sir?
Yes. So see, let me just go back to that slide. So the point which you are remembering, Tanya, is this. It is technical analysis is basically based on two things: the price of the share and the volume of trading. Shruti's question was, what is volume of trading? In response to that, what I was saying is that volume of trading refers to the number of shares which are traded during the day. That means how many people bought how many shares during the day. Forget about people. How many shares were bought and sold during the day? So a company has literally thousands of shares which it has issued. Now, on any given day, these shares which it has issued, it is distributed among the shareholders. So how many of these shareholders came up with a need to buy or to sell the share? So that is volume. Now, what that means is that people are taking interest in the shares. So let's say that everybody is selling. Then it will tell you something now. Let's say it's a very big volume and all those people are selling the share. That means that the share price is going to go down. Understand, Tanya? So if the share price is going down, somebody who has already bought a share and he suddenly feels a little, jittery that how will I be able to hold on to this share? People are selling it. He may want to sell. Somebody else may say that the share price is going down. Let me buy some shares. The price is coming down.
Yes,
Now, to understand the movement of the price, I also have to understand how many people are responsible for this price. So if the price is 200, it moved to 210. That means there was some trading. How much was that trading? Was it a very small amount? Was it a very big amount? Number of shares, I'm saying. If the numbers are big, then that indicates that people are interested in buying or selling this share. So then it is a stock of interest. That much is very clear. Now, whether to buy or to sell, that decision we'll see from the next part here. So basically, when you collect data over a long period of time, you are able to look at these different patterns. So the point I was making is that anybody who has, even read a little bit about technical analysis, he will remember that there were things called head and shoulders, double tops, all sorts of things, reverse head and shoulders. These words will be there. And you will think, what are these things? So basically, these are patterns. The pattern appears like a man's shoulders and head. So the share price is moving like this, going up and then going down like that. So let's look at this. See this. This is a typical head and shoulder pattern. So I showed this yesterday Shruti, can you read this? What exactly has happened here?
The prices have gone up, and after reaching a certain limit, they have started going down. And then this cycle has again continued, and they started again rising and then gone down. This is what I can do.
But there is one difference here. No? The first time it went up from 100, it reached this peak of 130. It was not able to cross 130. From here, it began to go down. So the first shoulder is formed. This is the first shoulder. Then when it reached this support of 100, it wasn't able to go further below. It began to move up. Okay, now when it moved up to this 180. After this, it was not able to move further up. It began to go down. And this time again, when it reached 100, it stopped at 100. It was unable to go below 100 because 100 was the price at which it is called a support price. That means at this point, people are not willing to sell the share. So what happens is that when it reaches this point, a number of people feel that we should buy the share. As more and more people begin to buy the share price rises. And then you have the formation of the second shoulder. So you, at the end of it, when the pattern is complete, you can say that this is one shoulder, this is one shoulder, and this is the head. Now, looking at this, the problem for the technical analyst or for anyone is, this is a period of time. Let us say that this point here is, let's say, just for the sake of argument, this is the 1st of January. And this point here is, let's say, the 1st of April. So between the months of January, February, and March, in those 3 months, the share has gone like this. It has gone up, come down, gone up, come down again, and then gone up here, and then come down here. From here, it is going to take a different path. The problem for, or let's say the skill of the technical analyst is to understand that the share price is going to move in this way in the coming months. And he has to do that analysis at this stage itself, somewhere over here. Because there is no point in allowing the whole, the share price to move through all this entire pattern and it reaches 100. And then he says, oh, this is a head and shoulder pattern. It doesn't, then no money is made. Nobody invests, nobody buys, nobody sells, nothing happens. The thing is, if you want to make money out of this, at a very early stage of the emergence of this pattern, you must be able to say that, yes, this pattern is starting. Let's say that on the 1st of January, the technical analyst is watching this share and he sees that in the next 2-3 days, it is reaching here. And then he sees it comes down and it comes to 100. And then he finds that again, it begins to move up. It is not going further down. So now this person understands that looks like that 100 is like a support. The share price is not going to go below this 100. This is like a support which is there, the support of the market. Market at 100, what happens is people begin to buy. And the moment they begin to buy, the price, instead of going further down, begins to go up. So when the first, this first set of transactions, this first movement here, 100, 130, back to 100, when this forms, maybe, the technical guy can say that, look, this is the beginning of a head and shoulders thing. If he is correct, then what will he do? What should he do? If he is very confident that this is the beginning of a head and shoulder pattern, and let us say he is here at this point. Let's say this is February 1st, he's out here. He has witnessed this. What do you think he should do out here?
He should hold the shares up till 180.
But why not think more aggressively, Shruti? Shouldn't he buy shares out here?
Yes, sir.
He should buy shares over here. And then if he is correct, because he is foreseeing that a head and shoulder pattern is going to emerge. Now he has seen the first shoulder here. Having seen that first shoulder, and he sees it is beginning to rise, so somewhere over here he decides that, yes, this is definitely going to keep going. This is the head and shoulder pattern. So he will maybe buy shares now. So let's say he's not able to buy it exactly at 100. He buys it, let's say, somewhere around 110, and then he waits. And if he's correct, and this is actually a head and shoulders pattern, he will see the share price reach 180. Now, he doesn't know whether it will stop at 180 or it will go more. That he doesn't know. There's no way of knowing that. So maybe he will, when it comes to 180, he sees it's going to go more. Let's wait. He waits. And then he sees that it begins to come down. So when it begins to come down, he then realizes that the peak is over and now the time has come for me to sell. So if he sells it here at, let's say, 170 and he bought it here at 110, he makes a neat profit of 60 rupees per share. That is what the purpose of the analysis is. The other option for him is to, we'll discuss this a little later, is to sell first and buy later. That is another thing which can be done in the share market. We'll discuss this a little later. So anyway, this is what has happened here. Now, you can sometimes see the same thing in reverse. So it started at 100, it went down to 70, it climbed up, reached 100, could not breach 100, could not go over 100. Then again began to come down, reached 45, and then began to move up. Now, in this case also, basically the technical analyst, if he, let's say, witnesses the first part here, this reverse, the first reverse shoulder, he can say that maybe this is the beginning of this reverse head and shoulders pattern. And then he can decide to make money on this. So one way you'll understand it better is he waits for it to reach 45. He sees it begins to rise, thinks that, yes, this is going to go up now. He enters the market here, allows it to go up, sells over here, makes money. So this is how the technical analyst actually works. So he says has happened in the past. On the basis of that, he's predicting that it will happen again. If he is correctly able to see the beginning of this pattern, he begins to invest accordingly and he makes money. This is the whole idea. Are you getting the point?
Yes.
Yes, sir.
Tanya, now if somebody asks you what is technical analysis, at least try to remember that these patterns are there.
Yes, sir. Yes, sir.
Okay, this is one. Now look at this. This is called a double top chart pattern. So you see it's a different type of formation as compared to the last one. In this particular case, you see the pattern like this. It goes, peaks, comes down. Again goes, peaks, comes down. And then it moves up to this. This is the first top, comes down, moves up again. Another top is formed. So this is double top, comes down here, reaches the support line. The support line is also called the neckline. And then it crashes below. Once again, the skill of the technical analyst is to pick up this pattern at an early stage. So the earlier he picks it up, the more money he will be able to make from this pattern. Now, even though it's a little hard to believe that share prices actually repeat these patterns, the evidence based on huge amounts of data indicates that these things happen. And because of that, it is possible for someone who is able to successfully identify the beginning of such patterns. Please note, the beginning of the pattern. If you see the whole pattern and then say, look, this is a double top, it doesn't make anyone any money. You want to make money on this, you will have to pick it up fast. If you are able to pick it up at an early date, you are in a position to make some money. So this is the concept of technical analysis. Now, if we continue with that, with the technical analysis thing, So another, very popular tool in technical analysis is the concept of a moving average. Do you understand what a moving average is? Shruti, Tanya? Any idea?
Constant रहता है.
No, not like that. Let me just show you. So 10-day moving average is the average of each 10-day sequence for, say, the last 6 months. Let me just open an Excel sheet and show you how this works. Okay, just imagine that this is day 1. This is day 2. Now, like this, okay, so we have 10 days. Let us say that on day 1 to day 10, you have something like this: 4, 6, 7, 9, 3, 7, 3, 8, 5, 2. Let's just, for the sake of understanding this a little better, let's say that this is the share price over 10 days. Okay. Now, from here, let's just take this. Okay, let's do one thing. Let us take a 5-day moving average. So a 5-day moving average means, let's say that I'm calculating the average for these 5 days. From day 1 to day 5. What will be the average? It will be basically the average from here till here. The average is 5.8. Moving average means, now, suppose I want to find the average for the 5 days starting at day 6. I will start here. See, the first time I started here 4 and I came to these 5 days. So this was what I had done. Now, for my next day, day 6, I will go from day 2 to day 6, this part. So basically, I will get the average here now. It will be average. I'll go to, can you people see this, what I'm doing here?
Yes, sir.
Okay, this is my average. Now, if I want to do it on day 7, what will I do? I'll start here and come up to 7. So I do this. I go here, start here, and then I take 5 days up to 7. Now, when I do this, I am getting this. This is the moving average. It was 5.8. This is an average of the last 5 days. This is the average of, again, 5 days, but moving one up. So each time what you are doing is the 5-day sequence is moving 1 day up. So in a number of days. So basically, everybody is clear about this.
Yes,
Tanya?
Yes, sir. Clear, sir.
Clear, na? Now, if you are clear about this, then this will be very easy to understand, this part. So when we say 10-day moving average, now you understand what has happened.
Yes, sir.
So I keep looking at 10 days over a 6-month period. In that entire 6 months, I am not looking at share prices of each day I'm getting the average, but I am looking at the moving average for 10 days, which basically, what am I trying to do with this? Why do I place so much of emphasis on this moving average concept? Now, how is it better than average? Can anyone think of this? Why is the moving average better than the average? See, because it will give you a clearer idea about the average price. Otherwise, if you look at average for the entire 6 months, then that will not tell you the story as completely as this. This will tell you on a daily basis, average, is the average showing an increasing trend? If I take 6 months and I take the 180 days in my 6 months and I get the average of 180 days, let's say I take the similar figures and I get one figure. Let's say the figure is 7.2. So I know that the average share price during these last 180 days has been 7.2. But now, suppose I do a 10-day moving average for this entire period. So what I will now get is, I will get the cumulative average of all these things. Every day it is going to move. And at the end of it, 10 days average, next 10 days, add that, take the next 10 days, add that. You can get a average of the moving average also. So it will be more reliable in terms of at what is the average share price. The other thing the moving average will tell you is that if I take these 10-day periods and I line them up, are they moving in this direction up or are they moving down? So with the same amount of data, I'm able to understand the movement better. And so what you can do is, if let's say you see an increase, in this 6-month period, then this means that there is some trend which is starting. This is a trend, it's moving up. The implication is that it may continue to move up because it has been doing so consistently for the last 6 months, and not because of 1 day or 2 days, but we are taking averages of 10 days. So it's very reliable that way. Now, suppose I take a 10-day moving average and I also add another parameter, 100-day moving average. So now let's say I'm analyzing it over 1 year, and every 100 days I begin to look at the moving average. Again, the figure that I will get will again be a figure which will tell me a lot about the way the stock is moving. And if on the basis of all this, I begin to feel that, yes, there is a very clear trend where this stock actually begins to move up, then I need to invest and make some money on that. So for example, what I've said here is my 10-day average also shows it's moving up. My 100-day average also shows that it is moving up. That means there is a lot of stability in this upward trend. Therefore, as a technical analyst, I would say that, yes, it makes
So I'm not getting your voice.
Shruti, am I audible?
Yes, sir.
At which stage did I lose you people?
Moving average of 100 days we were talking about.
Okay. So what I was saying is that if I take a moving average of 100 days, and then, how has this happened here? Host has disabled participant screen sharing. I'm not the host.
Sir, you got left, so I became the host.
Acha, acha, acha. Then how will we share this? Can you?
Yes, sir, I made you the host.
Okay, fine. See, Shruti, what I was saying is that if I look at the 10-day moving average and I see that it is moving up, I look at the 100-day moving average, I see that is also moving up. Then I tell myself that this means that there is a trend, this price is going to continue to move up. So then I can invest. And I invest, and as a stop loss, that means I don't want to lose money. So what I do is I keep, I stay with the stock. Then what happens is, if I am unfortunate and it begins to actually go down, then I can sell at 10% below my purchase price. It is just a way of checking your loss. That's all. Nothing more is being done. So this is not something which you have to follow or something. The person who suggested this, he was simply saying that if you're playing this game, you should have a certain, like don't lose more than this. Make some money while it is going up. Whatever remaining shares you have, you sell it off at a loss, but never more than 10%. So try to make profits of more than 10%, never make a loss of more than 10%. That way, what will happen is, so he says, pick many stocks, it is possible that you will make a profit. You may lose in some, but if your timing is good, you will lose less than you gain. So the point which even this analyst is saying is that there is no way that you will get it right every time and you will always make money. You will win some of the time, you lose some of the time. The only thing which you can hope for is that when you win more than what you lose. Okay. But remember, this is pure speculation. Risk is very clear. And if you're wrong, you will take a hit. You will actually hurt yourself. Now, what are the long-term techniques? If I want to invest, if I want to look at these different techniques, long-term technique is basically fundamental. I pick a good stock, I buy and I hold. I stay with that stock. And then when the value goes up, I make a capital gain on the sale. If you stay invested for long periods of time in good companies, you will always make some money, which is better than whatever you could have made in the bank. That is my main point here. This is one. Now, cost averaging. So basically what this technique, cost averaging, says is, do not buy, suppose you plan to invest 1 lakh rupees. The idea is, and you want, let's say you are able to, the price of the share is about 200. You're planning to invest 1 lakh. So you can buy 500 shares. So cost averaging says, don't buy all the shares on one day. So if you buy all the shares on one day and then the price goes down, then the chances are that you will begin with a loss. You'll buy, let's say, at 200, the price goes down to 180. Then you'll think that I've made a loss here. You've already put all your money into it. There is no way of changing your entry price. If you bought at 200, you're stuck at 200. But suppose I have to buy 500. I buy 100 shares only. Excuse me. I buy 100 shares only. And let's say I buy this at 200. Then after some time, I see that the price has gone down. I buy 100 shares again. After some time, again I buy 100. Maybe this time I buy at a little more than 200. Again, after some time, I buy at a little less than 200. I have 5 opportunities to buy 100 shares each. If I am able to pick my days properly, I will end up with an average which is maybe less than whatever the price was on the first day. The first day price was 200. If I do this over 5 months, there is a very good chance that I will be able to reduce my average price, average cost price of the share to less than 200. You understand this? Shruti?
Yes, sir.
Tanya?
Yes, sir.
So this is called cost averaging. So what, and if ever you people invest in shares, first of all, go for long term. First advice. Second is, don't buy the share, whatever amount you want to buy, don't buy it in one day. Buy it over a staggered period of time so that you'll be able to probably get a better entry price. Then there is this concept of day trading. So there is this story, which is true actually, about a person who sat in a Ola taxi, and the taxi driver, he was driving and he had his mobile on, and after he was looking at it from time to time, and they reached a traffic jam. It was a long amount of time. So the customer, the person who had sat in the Ola, he observed that the Ola driver is continually, looking at his mobile. Then he noticed that he is actually doing some online trading. That means he is buying and selling stock using an online trading app. After some time, the fellow, he, before the traffic light actually turned green and before the traffic jam cleared up, what he did was he told his customer that, look, I was able to make 100 rupees in this traffic jam. He said, how? He said, basically, I just picked one company. I bought shares. In the last 15 minutes, the share price has gone up by about 5 rupees. I had bought 20 shares, so I have made 20 into 500 rupees. So basically, what the person has done is, in the half an hour of the traffic jam on that same day, he is able to buy and then sell. So he says that for me, what I do is every time I hit a traffic jam, 2 or 3 times a day, I try to do this. He says sometimes I lose, sometimes I win. So this is pure gambling. But in the process, I am able to actually make a little bit of money, if I am correct. So this thing sometimes works beautifully. So you get up in the morning at 9 o'clock as the trading starts. Based on whatever stock tips you have, if you actually invest, you find that in 5-10 minutes, you are able to make about, say you invested 5,000, you're able to make about 200-300 rupees, and then you quit. So this sort of trading is referred to as day trading. This is not investing. This is just day trading. Something which is even more risky, pure gambling, is margin trading. So here, part of the money required to buy this stock is borrowed. You borrow this money from your broker, invest it in a stock. So you're not investing your money, you're investing the broker's money. And what you are hoping is that you will make a profit. And then at the end of the day, you will earn some profit for yourself and repay the interest which the broker is charging. So this sort of practice, that is known as margin trading. Once again, something which you should not ever try to do. If the margin is 50%, you can borrow a sum equal to the amount you are investing. Basically, what I'm trying to say is, if let's say you have 10,000 rupees of stocks with that broker, you have bought stocks in the past, the value of those, current market value of those stocks is 10,000 rupees. The broker is willing to give you 5,000 based on the security of those stocks. So you can, he'll give you 5,000, you use the 5,000 for trading, and then if for any reason you do not repay the broker, he has that security of 10,000, the stocks which he has. On that basis, he is able to get back the money which he has given. Why does the broker do this? Basically, he is earning interest, and all brokers will try to get you to do margin trading so that they can earn more money. And what they will tell you is, they will give you this temptation that, look, you can make lots of money in day trading. Why use your money? Use our money, and it will be easy for you. So the stocks that you buy are pledged with the brokerage house. If the price of the stock drops beyond a certain level, the brokerage sells the stocks and adjusts the loan. So the brokerage is absolutely safe. You are taking a bet. What you will lose is, if the price drops, you will lose that. The transaction will be a loss for you. You will buy high, sell low. And you will also have to pay a certain amount of interest or brokerage to the broker. So that is known as margin trading. Now, I just want you to, basically the last part of today's lecture. Let me just sort of focus on. So we've looked at these different techniques, and the question that we have before us is, how should we actually proceed? What should we do to proceed? We've looked at fundamental analysis. We've looked at technical analysis. We've also had a look at day trading. So the problem for us is, what exactly should we do how should we proceed in the future? For that, I will give you this last bit of insight, which, just give me 1 minute. Okay. So now let's say that I want to actually start investing. So how should I actually go about it? So the idea is basically that I identify good companies. If you can't, so do a bit of fundamental analysis on your own, look at some of those ratios which we looked at, find some companies, and then look at what other people are recommending. Look at what what sort of a reputation they have, what are other brokerage houses who are recommending. Now, the first thing which you should be concerned about is that the balance sheet of this company has to be clean. Now, when we say clean balance sheet, that means the promoters are genuinely trying to make the company stronger and more profitable. If the promoter is doing that, then the company will continue to grow. If the promoter is simply using the company to generate profits, which he then manages to take away from the company into his personal account, then obviously that company in the long run is not going to do so well. So this particular aspect has to be there. So the reputation of those people, I remember I said quality of management, that is one very important aspect. The sad part here is that according to some of the analysts on which you can listen to YouTube videos of, particularly more recently, you will find someone who's been, I think, making a huge stir, someone called Saurabh Mukherjee. If you look at some of his videos, he will tell you this, that 80% of the companies do not have clean balance sheets. It's very disturbing. But in the country, 80% of the big companies don't appear to be trustworthy. Promoters are siphoning off funds from the company to their personal accounts. Even after decades in the business, the company does not have free cash flows. Think of this. You have been in the business for 50 years, 60 years, and even today you are not able to have free cash flows. That means you are selling too much on credit. You are not getting that sort of credit from your suppliers, and there's no cash in your company. That is one part. The second part is the company making a product that has a large market? So the thing here is, the average consumer in the country cannot afford a high price for an essential commodity. So only companies which can sell good quality products designed for mass consumption can make money in the long run. So if, to have a really big market, it is necessary that the company should be making a product which has a low price, which everybody can buy. So I think in one of the first sessions which we had on equity, I had mentioned Relaxo footwear, where we said that if you want to buy a pair of Hawaii chappals and you go to Amazon, the cheapest Hawaii chappal available is from this particular company, Relaxo footwear. The next one on the next cheapest one there is at least 40, 50 rupees higher in price than the chappal which Relaxo is selling. Now, as a result of that, they sell literally crores of chappals in a year. So the market is unlimited. And so if they can produce more chappals, they end up selling more chappals. So if I can find different companies like that, I can do well. How do I find companies like that? You listen to videos, do some reading, you will see that this job has been done for you by analysts. Pick companies like that, look at their balance sheets, use those simple techniques that we discussed, you will begin to understand this better. The last point, this particular point, once again, I should mention that this is a point which I have taken from a Saurabh Mukherjee video, which I found very interesting. Are there solid barriers to entry? That means if a company is working in, let's say, any industry, let's take the chappal one, footwear. Is it possible for other companies to enter the business and start a company and take away some significant market share that is yours? If it is easy to do that, then that means that there will be a lot of competition. And if there is going to be a lot of competition, then what will happen is that the market share of the company you are looking at will not increase beyond a certain point because there will be so many players coming into the business. But if there are certain things, certain barriers which are there, which prevent a person from doing it. So for example, in the case of Asian Paints, one of the barriers which is there for anybody who wants to compete with Asian Paints is that they will have to find a way of supplying paint to almost 70, 80,000 dealers across the country. On Asian Paints does it in 3 hours. They are able to provide a replenishment of paint stock in 3 hours. Now, the technology and the big data that they have, which makes this possible, that is something, that is the barrier. Nobody else can match that. Dr. Lal Path Labs, the way they do their business, the accuracy, the reliability of their reports and everything, once again, they are based on technology. Nobody else is able to match that. And if they are not able to match it, that is the barrier. So if there is something unique that that company is doing, which somebody else can do, that is the barrier which stands in the way of a competitor coming and grabbing some of the share. And that is exactly, if you can find companies like that, those are the companies in which to invest. Some of the companies that we mentioned right now are like that. Like, for example, Relaxo or Asian Paints, Dr. Lal Path Labs. These are companies which tick all these boxes. So if this is the case, I invest in this. The condition is, so let's say I use cost averaging to keep buying shares when the price drops low. And then I stay in this company for 3 years, 4 years, 5 years. In that period, the return that you will make is going to be solid. So my advice to you is definitely invest a portion in equity when you begin to earn. But do not ever fool yourself that it is a route to quick rich. You're not going to become rich quick in this. You will make steady returns provided you have the patience to stay in the game for 4 to 5 years at least. If you can stay for a much longer period, you will do even better. If your companies are good, if you are basically looking at good companies, and it is very easy to do this if you just keep up to date, listen to different videos on this, read a little more about this, stay abreast with the news. You will be able to take help from people who are professionals. Then use some of the little, tips that we've discussed during this particular course. See if everything fits, and then go for an investment. Are you getting this?
Yes, sir.
So that is the idea. So Tanya, when you had asked, I remembered before we started the equity, okay, how exactly do we decide how to invest? This is my answer.
Yes, sir. So I got it, sir.
Okay. So now that we've cleared this, we have, I think, more or less come to the end of this particular thing. So these are points here are, once again, just reiterated in this slide. And the same thing, once again, is given here also. Clean balance sheet, nature of the services sold, competitive advantage. This is the barrier to entry point. And are the promoters honest? This last point actually is the one which is the most disturbing. So all of you know that NPAs have increased so much in the banks. What is NPA? When somebody does not repay his loan. He doesn't do it continuously for 3 months. The bank says that my loan is in trouble. They call it a non-performing asset and they try to take action to recover the loan. The amount has been so large, and so many big good companies have actually not repaid money, that the only lesson that you can draw from it is that a large number of these people are actually not honest. They are taking loans, and during the course of a few years they are taking money from the company, and they are bleeding their company and taking the money away. That is one sad reality. That is why when we go for investing in companies, we have to be very careful that we invest with companies which have a clean track record. If you really begin to read about the company, begin to research it a little with the resources that we have, you can actually identify good companies and invest in those. So this is the end of our equity section, and from next week onwards, we'll start with alternate modes of investing, which is we'll try to finish that next week itself, and then move on to some of the other things which we have in the course, like the working capital part, financial ratios. So once again, the financial ratio part, which we will discuss, will once again help you in the fundamental analysis part. The working capital part that we'll discuss, that will again help you to understand the fundamental analysis part, and in the process you will also learn a lot about the accounting part, and then we'll end with a small section on the banking part. Okay, so that's it for today. Any questions, anyone? Shruti, Tanya?
No, sir.
Okay, then we'll end it here today. Good night.
Thank you,
And
sir.
So Shruti, your college is starting.
Yes, sir.
When? From tomorrow?
No, sir, from 21st February.
21st February. Achha. You still have 8 days. Achha,
Yes.
next Monday. Chalo, good. Then see you people next Saturday then. Okay.